Insiders do not have better perspective on prices than the rest of us do. Energy companies cannot forecast oil. Mining company executives are unable to predict gold or copper prices, and real estate executives cannot accurately project real estate prices. Insiders acting on the internal operations of their own companies, since they know what's going on, those signals are much better than these signals. In other words, these fellows, even though they are in the industry, are not much better in predicting energy prices, metal prices, or real estate prices than the rest of us are.
Hello, everybody. This is Dr. Richard Smith, and I am here today with fellow board member and a analyst whose perspective I always deeply appreciate, and I always get so much out of his presentation. So I'm very happy to be bringing a very special presentation to you today with Bill Sarubbi. So Bill is, as many of you know, a frequent contributor to Forbes. He's been a professional money manager on Wall Street and with the Abu Dhabi Investment Authority, a man who's really put his money where his mouth is and has produced fantastic results and whose insights always surprise me and I always get value from. So thank you so much, Bill, for joining us.
You're most welcome. Thank you for your invitation.
Yes. And in particular, I'm very excited about finally spending a little time together in person at the upcoming Cycles Live in 2025 in New York City.
Yes.
It's going to be great to get together. Can you just tell us a little bit about what you are looking forward to about that conference and what you'll be sharing there yourself?
Yeah, I'll be doing the market outlook based on cycles.
So a mid-year update, so to speak.
Yes, that's correct.
And is there anything you're particularly excited about with respect to the conference? People you're looking forward to seeing, getting together with?
Being in my hometown and seeing, getting together with people I have not met and some whom I already know.
You and I actually have never even met in person.
That's right.
So I'm really looking forward to spending a little time together. And what do you have for us today, Bill?
This is contrary opinion, which is one of my favorite subjects. And this is Cycles Research Investments. You can get me at cyclesresearch.com. And this was really, as far as I know, kicked off by the book by Humphrey Bancroft Neal called The Art of Contrary Thinking. And it led to what's called the theory of contrary opinion, which a lot of people try to use. I remember one conference in which they asked, how many of you here, about 200 or 300 people, how many of you are contrarians? And about 80% of the people raised their hands, which got a big laugh because how can everybody be contrary to everybody else? Right. So anyway, Humphrey Neal, 1895 to 1976, former World War I lieutenant, served under General John Pershing. He was a noted economist. And he said, when everyone thinks alike, everyone is likely to be wrong. So that is really, that's the basis. And this is a potent factor behind the...
You're going to take us through a kind of a historical walkthrough of...
That's correct.
The history of contrarian opinion, and maybe share a few insights about what it tells us about markets
I'm going to
today.
do that. Or as Joe Granville used to say, what everyone knows ceases to be useful, or the obvious is obviously incorrect. Now, that is Neal, and the public, he said the public is often right during the trends, but wrong at both ends. In other words, at the beginning and the end. He was also the one who said, don't confuse brains with the bull market. And when everyone thinks alike, everyone is likely to be wrong.
That's all from Humphrey Neal? Humphrey McNeil?
Humphrey Neal. The purpose is to contest the popular view because popular opinions are so frequently wrong or to be untimely or plainly wrong. The two earliest proponents, after Neal, were Leon Fraser, the American diplomat, and his son James, founder of the Contrary Opinion Forum up in Vermont. And this is a good definition, I think. It is a method of ruminating over a broad range of public questions, political, economic, and social. The object of contrary thinking is to challenge generally accepted viewpoints on the prevailing trends in politics and socioeconomics. In sum, the purpose is to contest the popular view because popular opinions are so frequently found to be untimely, misled, or plainly wrong. A crowd yields to instincts which an individual acting alone represses, or as William Stanley Jevons once said, as a general rule, it is foolish to do just what other people are doing because they are almost sure to be too many people doing the same thing. So, one of the greatest developers of contrary opinion was my old friend Paul McRae Montgomery of Newport News, Virginia, who studied 3,200 covers of Time magazine. He found that when there was an investment-related theme on the cover, price moved in the opposite direction to that which the cover suggested. He stated that there was an 80% probability that the price would move within the next 4 months. If an investment-related story was on the cover of a non-financial publication, the effect was stronger. So in other words, whatever the opinion was, buy this, with an 80% probability within the next 4 months, that asset would be lower in price, and it was the reverse for sells or for bearish covers. And it was much better, this contrary opinion magazine cover tool was much better at spotting lows than highs. And Paul and I had a conversation when I lived in Greenwich Village in New York in the early 1980s. I said, Paul, when I go to the newsstand, most of the magazines I see are of scantily clad women. Does this mean sex is going out of style, and how can we profit from it? We both had a little chuckle, not realizing that that was the beginning of the AIDS crisis. So contrary opinion not only affects markets, but also social movements and trends. Now, Paul's rules were the headline generates contrary behavior in investment markets. It must be a primary headline. It must be on the front page, preferably above the fold, and must appear in a non-investment daily. Examples. In the 70s, there was a Newsweek cover showing South African riots, and it says, South Africa riots challenge to U.S. authority, with a question mark. That coincided with a low in the South African gold mining stocks. Then there was the 3 Mile Island crisis, which coincided with the low in the utility index in 1979. Financial publications produce a lessened effect because they must have financial news on the cover. What else would you put on the cover of the Wall Street Journal or Barron's? So, insiders. Insiders do not have better perspective on prices than the rest of us do. Energy companies cannot forecast oil. Mining company executives are unable to predict gold or copper prices, and real estate executives cannot accurately project real estate prices. Insiders acting on the internal operations of their own companies, since they know what's going on, those signals are much better than these signals. In other words, these fellows, even though they are in the industry, are not much better in predicting energy prices, metal prices, or real estate prices than the rest of us are. Now, Paul, in his own words, our magazine cover indicator is the most well-known of several analytical protocols that involve using the news media as contrary indicators of future direction of the investment markets. It would be well for investors to be on the alert for these other media indicators because they can be important as well, perhaps increasingly so. A recent study by the Bespoke Investing Group found that when investment stories were significantly reported on the Judge Report, such treatment has tended to have contrary implications going forward. More specifically, stock market bottoms tend to occur when Judge covers the market. Tops tended to occur when there was no Judge coverage of the market. There is also some anecdotal evidence that Nexus and Factiva searches and other such word counts have some value in identifying when certain investment themes have become so well known that they are likely in a terminal phase. Now, his favorite covers of Time magazine, the electric utility king Samuel Insull controlled an empire of $500 million with only $27 million in equity. He got wiped out in the Depression. This cover appeared in the late 20s or maybe around 1930. And the next one, the Match King, Ivar Kruger, October 28, 1929, just before the crash wiped out his empire. And then there was Thomas Lamont, who was with J.P. Morgan and Company. And on Black Thursday in 29, he was the acting head of Morgan. 5 days prior to the crash, President Hoover had contacted Lamont with concerns about the market manipulation on Wall Street and the systemic risk it presented to the stock market, but Lamont assured the president that there's no need for concern. The future appears brilliant. The market crashed on the following Thursday. In an attempt to stop the panic, Lamont organized Wall Street firms to inject confidence back into the stock market through massive purchases of blue chip stocks. The effort failed, and stocks ultimately lost a quarter of their value that week. Now, here's some of Paul's favorites. This is from the Richmond Times-Dispatch of Richmond, Virginia. Now, that is not a financial publication. So stories on the cover count double or triple what the same stories would count on the cover of financial magazines. So the first one, fears drive perfect storm of selling. Then stocks plunge worse since 2008. Then global markets take a hit. You see the three arrows, they occur right at the bottom. So there's the same non-financial publication with three sell signals all at the bottom. Another one of his favorites, New York Post, definitely not a financial publication. Now the bottom 401ko, average retirement account down 25% under Bidenomics. Let's see where that occurred. We'll look at that. There's the post, October of that year, and there's the low. Then there was this one, the Daily Star, definitely not without a title, definitely not a financial publication. Honey, I shrunk the quids. The pound hits record low and interest rates likely to rise. We go to the date, and there it is, right at the low of the pound sterling. Now, this again is from Paul, and this is a summary of 4 different magazine covers. The first one, which is a bond market low, Volcker Anguish. It showed Paul Volcker sweating it on the cover of the magazine because bonds were declining. Then troubled government bonds. That was another headline right at that low. That was in 1984. Then Volcker appeared on the cover of the magazine of Time magazine as Volcker being the most powerful man, and it was right at a high. And then Business Week. Alan Greenspan is great for the economy at 1989, right at the high in the bond market. By the way, bonds were Paul's specialty. Then there was the skyscraper index, which I'm sure you're all familiar with, which was developed by Ed Dewey of the FSC. Further work from Paul Montgomery, Ray Wenslick, Andrew Lawrence, and Elliott Wave International. From 1790, very large construction projects tend to occur at stock market tops. Now, I found something from the 1300s that I copied and sent to the Elliott Wave International, which was about building a very big stone tower that would reach up toward the heavens and perhaps touch God or something like that, that occurred just it was the equivalent of an economic catastrophe caused by a famine. That was in the 1300s, so this goes back a long way. The Equitable Building was put up in 1870, just before the Panic of 1873. Both the Singer Buildings and MetLife, 1908, 1909, occurred right near the Panic of 1907. Empire State Building, 1929, the construction started, finished in 31 as the Depression took over. The Sears Tower, July 1970, just before that long stock market decline into 74. Then the World Trade Center was 72 to 74, again that weak first half of the 70s decade. Then there was the Petronas Tower in 1998, which preceded the 2000 bear market. Then the Burj Dubai, January 2020, the UAE market fell more than 60%. There was the Great Recession and the 2020 drop in the market. And Professor Mark Thornton, who has been my professor, he wrote The Skyscraper Curse, which is the most recent publication, which you can get at that at the Von Mises Institute. You can get the book at that link. And now, just put this into the presentation a few days ago. The world's tallest bridge to open at dizzying 2,000 feet above ground. The Canyon Bridge, which will become the tallest bridge in the world, is rapidly approaching its completion date in June. The Chinese Suspension Bridge, which has been raised 20,051 feet above a gorge, will top the list of the world's highest bridges and has been completed in just 3 years. To put that dazzling height into perspective, the tallest skyscraper in the U.S., One World Trade Center, is 1,776 feet. So that is one sign of the current times. And let me give you some past examples that I used. Big oil's surprisingly bright future from Barron's occurred. That was the date of the magazine cover, and oil prices have not gotten above that $85 level ever since. In fact, have now broken support down to me like they headed into the 50s, or 50s or even the 40s. And another favorite of mine, a buy for green power. Let's see where the clean energy crash, and you see the crumpling stand on the windmill. In other words, it's bearish. And where did it occur? Right here on the wind powered WNX index. That was the date of the magazine cover in 2023. And as you can see, it is up. It has been up at least from 65 to 90 is about a 50% increase. It's still above that level. So as you see, these things do work with the covers of financial publications. Now, this is one of my favorites. This graph is the Consumer Price Index from FRED, Federal Reserve Database. And there are four arrows. The first one, there was a Bloomberg cover, which I do not have, which talked about the death of inflation. And then Paul Volcker, the Fed chief who reined in inflation, raised interest rates, brought inflation down, he dies. Then there was a Schwab comment from Klaus Schwab and Thierry Malloret. At this current juncture, it is hard to imagine how inflation could pick up anytime soon. And then I added in James Dines dies. He was the author of The Invisible Crash way back in the 60s, way ahead of his times, who pointed out how inflation was going to take over and turn the economic world upside down, which it did. So all those occurred at a CPI low. And here's one of my most recent ones and one of my favorites. The NVIDIA contrary opinion sell signal, November 18th, 2024. Now, let me say that those of you who have seen my other presentations for the foundation know that was a monthly high in the price cycle for NVIDIA stock, completely separate from this magazine cover, which is Barron's. And here's the result. That was the magazine cover, and I think we're down in here now, aren't we? Because NVIDIA's been weak in the last few days, I do believe. So as you see, it's still working with financial publications. Now here is the fund manager of ARK, whose name I forget, but she's in the media very frequently. She was on Bloomberg Business Week's cover, and her fund was down 60% after she appeared on the cover of Bloomberg Business Week. Or this is a great one. This was published at a low. Now this is The Economist. It is a financial magazine, but it's more related to economics than it is to price movements, the way the Wall Street Journal would be. Crypto's downfall. Does anybody want to guess where this fell? Well, right there. That looks like a low to me because crypto, I'm using the Bitcoin spot rate. And as you can see, price was up about 10 times after that. So this was really a very good indicator of that low. And another one of my favorites that I used in my weekly message to the institutions, Barron's, the powerful greenback. Well, what do you think this would be? A high in the dollar. There we are, dollar strong. There's the cover. There's the dollar being strong. And as you can see, it's been down ever since. It hasn't exceeded that high yet. The underlying principle, as Paul would say, is when there's an investment, or let's just say a price movement, the reasons for it may not at all be evident at the low. Yet when it keeps going up and it keeps going up, finally it starts to attract attention. It usually attracts enough attention that the most of the publicity occurs at a high. And Paul would say that The fact that an investment-related story gets through to, let's say, People magazine or the Richmond newspaper, it's become so strong that even the general public starts to know about it. I was sitting in my office at Value Line in 1979, and the guy who had the next office said, that's the way he talked. His name was also Bill. He said, I went past Deke Pereira, and there were all these blue-collar people lined up to buy gold. You didn't see them lining up to buy gold at a low, did you? And of course, the high was January 1980. In fact, I used to go to the magazine newsstand in Grand Central Station before I went to work at Payne Weber, and I used to just take a look at all the magazines, just looking for investment-related themes. Now, here's my favorite stock market signal. MarketWatch ceases halberd operations in June of 2016 because people weren't that interested in stocks anymore. They used to rate my portfolio. And here's the second one from Der Spiegel. The end of the world because the orange man is coming to eat up the earth. Let's see where that fell. There you go. Holbert ends ratings and Trump end of the world. So it's the end of the ratings and it's the end of the world right at the 2016 low. And here's one of the greatest hits from 2016. Donald Trump on the cover of New York as the loser. They published this and they had to retrieve it the next morning of the election. And I guess it's a collector's item now. And I'll show you two more. The reason I advise you to stay off the covers of magazines. Number one, Two Kisses of Death. Vice President Harris on the cover of Barron's. Now, Barron's is not a political publication, so this counts two against Harris. And then there was being on the cover of Time magazine. So this was just prior to the election. I did a presentation in which I said, I thought Trump would win anyway. But so continuing with our theme of politicians, here we have one that is bullish for the U.S. economy. Donald Trump is getting ready to torch the economy with fuel and flames on a pile of dollar bills. And here we go to The Economist again, the ruination day. I guess Donald Trump cutting the borders. This has to do with the tariffs. But let me point out that Forbes, staying off the cover of Forbes, is something to keep in mind. On the right, you recognize Sam Bankman-Fried, the crypto fraud and collapse, and we put the go to jail card in the middle of the presentation. And then on the left, I forget her name, but that was the Terranos fraud, where she had not developed the medical technology she claimed to have developed, and her company collapsed. Now, academic support. Is there any academic support for any of this? The March-April 2007 issue of the Financial Analyst Journal featured an article entitled Our Cover Stories Efficient Contrary Indicators. Headlines from featured stories in Businessweek, Fortune, and Forbes were collected for a 20-year period to determine whether positive stories are associated with superior future performance and negative stories are associated with inferior future performance for the featured company. Superior and inferior were determined in comparison with an index or another company in the same industry and of the same size. Statistical testing implied that positive stories generally indicate the end of superior performance and negative news stories generally indicate the end of poor performance. And in fact, it was Harvard professor, I'm trying to think of his name, begins with an A, but he gave students mythical portfolios and two groups. The one group he gave price charts. The other group he did not give. He gave price charts and he also gave news. So as the stock rose, they were given stories like company is planning dividend increase, company stock to split, company recommended by Wall Street. The other group got no such stories. The group that didn't get the stories returned an average gain of 27%. The group that did get the stories, an average gain of 17%. If I can think of the professor's name, I'll tell you, but I think it was two A's like Alan Anderson or something like that, but his name just escapes me right now. Now, application to the futures market. The Theory of Contrary Opinion, a test using sentiment indices and future markets by Sanders, Irwin, and Luthold. I am not going to go into that, but I give you the link down at the bottom so you can go and read it.
Fantastic, Bill. Quite shocking, actually.
No, well,
what do you make of it?
Well, see, if you've worked and lived in New York, I've had the only thing I didn't do was be a runner and a trader on the floor. But I was a fundamental analyst. I wrote newsletters. I used technical analysis. I used fundamental analysis. I used both of them together. I was an institutional brokerage, retail brokerage, and then finally a fund manager. And people fear the unknown. And as Rollo May says, fear will attach itself to whatever is around. And so the stock market is fearful because it's unknown, and people grasp for news to support their views or to support stocks going higher or stocks going lower. Without that, they feel very, very insecure. So they've got this fear-driven feeling that they need justification for the movement in the share prices. And so obviously, as a stock is going up, if you're a writer, like I write for Forbes, you tend to reach for the good news basket if the stock is going up. And if the stock is going down, you reach for the bad news basket and pull stories out. And of course, there's a whole industry out there that has to try to convince us that we need their news in order to be successful in investing. And I think a lot of this shows that I wouldn't say you don't need it, but you have to apply it in the right way.
I mean, one thing that came to mind when you were talking about how insiders can't predict prices, and yet every year the media religiously presents us with the forecasts for the S&P 500 at the end of the year.
I always note that.
All the economists and bankers, right?
And
they're almost never right. I mean, it's just insane that this happens year after year.
And there also is a pressure to conform, because when I was on Wall Street doing only fundamental analysis, you had the IBES average and the range of all the earnings estimates on the street for a given company. If you were well away from the median, you got called in by management, and they wanted to know why you were more bullish than anybody else or more bearish. And value line tests show that if a company reports earnings that's more than one standard deviation away from the mean or median provided by IBES, the stock would move sharply either up or down, depending on where their earnings were. And so if you didn't want to get called into the manager's office, you tended to hug the IBES median. And I ran into trouble immediately, several times, because, I just told them, I said, look, here are the numbers, add them up yourself. And you could see that they knew the numbers were right, but they didn't want to say anything too outrageous. So they watered down very much what I said. And to give you a true story, there's one of the most successful fund managers in all of Europe. He used to manage for the Arabs, so he used to come to my flat in Abu Dhabi. He and his group at a Swiss bank predicted the 87 crash, pulled all their clients out of the market. The market crashed. Bank clients who go to the same social venues, half of them said, boy, my portfolio got damaged. The other half, funds managed by the same bank, didn't get damaged. These guys who predicted the crash correctly and pulled their clients out were the only guys in the bank to not get bonuses for that year because they embarrassed the bank.
Oh my goodness.
The result was my friend quit and formed his own fund, which made him a billionaire in the 90s, being long technology stocks, which I was too for the Arabs. And to go back to Paul McRae Montgomery, this is, again, a true story. When the market tanked, Bill Miller, who was one of the leading fund managers in the country.
Legg Mason.
Yep, Legg Mason. The market was down about 20%, and he was only down 15 or 18. And he got called in, and they said, well, how come you're up 50%? Well, he ran a long short fund. He had a hedge fund. And he had obviously, been short. And he used total return was his goal, not benchmark to an index. The compliance people in that company could not understand that. And he explained it all to them. and they told him they're going to investigate him. He resigned and formed his own company. Those are true stories.
Unbelievable. So it seems like what you're saying is that the real underlying mechanism here is kind of the herd slash social
Yes.
Acceptableness urge that human beings have, to be safe and to be kind of, not too far away from their peers.
That is correct.
Do you ever read anything more sinister into it than that? I mean, some of those signals were just unbelievable.
Yeah, I know. That's why I keep a
Like
good
the
eye out,
collusion.
but it also works for social
Yeah,
movements.
right. So not necessarily monetary incentives there.
No.
Yeah, very interesting. So today, the main signals that you're seeing from the magazines are this kind of, if you take the current, media end of the world as we've known it message that seems to be getting the headlines right now, you're taking that as a contrary indicator?
Well, first of all, they're blaming the market movements on tariffs, which tells you that the market is not declining due to tariffs. I'd like to point out that Stan Harley and our pal Peter Reliades, two friends of the foundations, both were predicting for a decline in the market last year before the tariffs were even announced.
Absolutely.
And so that's number one. Number two is I was expecting a low in late March. I had a my opinion, but I became very worried because retail investors were buying when the market declined. And you could see the pros were selling and the retail accounts were buying. And that is not the type of sentiment you see at a low. The market's got to go further to make them very bearish to bring about capitulation. And I still don't know if we've seen that. I think one more good shot down now might do that.
Yeah. All right. Well,
And
so many things came to mind while you were giving your presentation,
well, I just
Bill.
wanted to repeat something I've said before, but
Yeah.
I was out of school in '72, and I went around trying to find a job, and people all told me to go someplace else, that Japan was gonna wind up owning the United States. The stock market would never be a place to make money again. I'm driving the car in New Jersey, and there's a sign, "Survived in '75." This was the 4th quarter of 1974. The market bottomed in December at about 500 on the Dow. Survival 75, right at a low, and this was a billboard on a highway in New Jersey, and people are all telling me to look elsewhere for a job. So that was a sign of a major low, and some of the major signs of highs have been all of the auction market information I provided very frequently or presented for the foundation, and the 2 that got me were the guy paying $1,000,000 for this art banana taped to a board, and then in front of the press, he eats the banana. It was $1,000,000. And there's Juan Soto's baseball contract, where I think he gets paid now $70,000 every time he walks to the plate.
I remember you bringing it to our attention.
These are the types of things that happen when money is cheap or too abundant.
Yeah. So
And
how does this line up with your overall kind of forecast for the market for the year?
well, just one more. I was talking to a friend of mine at Morgan Stanley. He's at one of the regional offices. He brought over a bunch of managed accounts. And at the beginning of this year, they called him in and they forbade him to use the SDS and the QID, which are the inverse S&P 500 and NASDAQ indices, to hedge against market declines, telling him that the market's not going to decline. That was the beginning of this year. Talk about a contrary opinion signal. Well, what it has done, I had forecasted based on cycles a down market into late March, and I was very doubtful because I hadn't seen capitulation. And as I said, the retail accounts were still buying, and the decline exceeded my expectations. I was looking for 8% down or so. It was about double that.
Mm-hmm.
And then when the market started to rally, I saw an unmistakable Elliott wave of, A down, B up, and now we're in a C wave, or maybe we were in a 3 wave. So if we haven't seen capitulation yet, I think there could be another sharp decline down. We've either seen the low or we're very close to it.
That's not too far from what I'm seeing too. Well, I'm
Okay.
really looking forward to getting together in
Me
person
too.
in New York. Stan Harley and Peter
Yep.
Eliades are going to be there
Great.
too. It's going to be an incredible gathering. And thank you so much, Bill. Your work is always so historical, so like documented, and we really appreciate it. Thank you again.
You are most welcome.
Take care.
Bye-bye.